This video is about Ansoff's Matrix and how it can be used to guide corporate strategy and decision making. Ansoff's Matrix is a tool that businesses can use to guide them in their strategic decisions and particularly strategies that they might use for growth. So it looks at how to expand, either through continuing to make and excel existing products or designing new ones, but then also whether they should continue selling in the same market to existing customers or expand into new and different markets. So it gives us this grid with 4 different strategic growth options, which we can now look at in turn with some examples of each one. So starting with the top left of our Ansoff Matrix grid, we've got market penetration, which you can see on the grid there is about trying to grow in existing markets with the same products. So this could be a car manufacturer continuing to make the same cars and selling them to the same market segment. But maybe they might look at trying to increase and improve their marketing to try and increase sales that way. So they're really trying to increase their market share, they're trying to drive out competitors, and they're trying to take customers off these competitors in order to increase their sales and in order to grow in that way. Now, the knowledge of the market they will have and the knowledge of the products that they are likely to be selling means that this is a relatively low risk strategy. But that does then mean that there's less potential for big rewards. And that's particularly the case if the market is saturated, meaning that most customers who are likely to buy the product have already actually bought it. And it also means that competition is likely to be quite intense, and so you'd need quite a strong, unique selling point to keep growing like this, to stand out from your competitors and to keep persuading customers to come to you over them. Moving next on to the bottom left of Ansoff's Matrix, we've got market development, which is about expanding into new and different markets, but continuing to sell the same products in those markets. And so this could be selling to different customer groups through repositioning, or it could be through new international markets. So the second of those with international markets is probably the most obvious one. So that could be a UK car maker start selling their cars in Europe and the United States as well. But repositioning is about trying to access and sell to different customer segments. So maybe you've always been known as a business that sells their cars to and for young drivers that have just passed their test. Maybe you could reposition your brand to also appeal to the older market segment as well. That would be an example of repositioning to new, different market segments, but in the same international market. Now, this area of Ansoff's Matrix does represent an increase in risk compared to market penetration. That's because most businesses know their customers and their target market quite well, and new markets will present unknown challenges. And we often see actually businesses moving into international markets fail because they don't know the culture, they don't know the customer preferences where they're moving into. But there are quite big growth opportunities here. With relatively little product development expense because you're continuing to sell the same products. And the knowledge of the products as well means that it's not a really high risk strategy. So it's usually seen as kind of medium risk because you know your products, you continue with your knowledge of that, but you're stretching yourself into those new and different markets. Going up to the top right of Ansoff's Matrix next, we can see the strategy of product development. So that's about expanding in the same markets, but by selling new products. So there we're trying to get an advantage over our competitors by designing and introducing new and innovative and different products to what they might currently have on the market. So that might be your car manufacturer bringing out new and improved models of car, maybe introducing heated seats, better stereos, inbuilt sat nav, anything like that to improve the product, but still broadly selling it within the same market to the same kinds of customer groups would be an example of product development. So again, this is a step up in risk compared to market penetration, and this time it's because of those research and development expenses. So if you think of these really innovative companies that are bringing out new products and new models all of the time, there's a really high level of cost involved with that, and there's no guarantee that each one they bring out is going to be successful. But staying in the same market with the knowledge of the customers that you build up over time, that does reduce the level of risk, and so it's usually seen as a medium risk strategy like market development. And the final section of Ansoff's matrix in the bottom right here is diversification, which is about expanding into completely new markets with new products as well. So this might be a car manufacturer suddenly decides to start making mobile phones as well, or they decide to move into making soft drinks and go into that market as well. And so Virgin's probably the example of the company that's done this most extensively, going from record shops to trains and air travel to broadband, digital media. And this is the highest risk of all the strategies. So you're going into these markets with products that you've got no background knowledge in, and it also means that you're taking what might be quite a well-known brand in your market into a different area that, like I said, we've got no knowledge of, and also you need to build up that customer trust that you can do this just as well as you could the market that you were previously operating in. But the good thing about diversification is that it offers the highest potential rewards, and while that level of risk is quite high in the short term, over the longer term it can actually help to shield the business from risk, because if the demand in one of those markets collapses for whatever reason, that's kind of what happened with record shops, and Virgin still have all those other interests to fall back on, you've still got that diverse range of different products to sell in other markets if one of those markets and one of those types of products that you're selling loses its demand. So Ansoff's matrix can be a really valuable tool in guiding strategic direction. So it can help a business, particularly when it's making those decisions relating to how they're going to grow. And as you go further down and further to the right on the matrix, the level of risk tends to increase. So product development and market development are more risky strategies usually than market penetration, and diversification is the highest risk strategy of them all. But with that greater level of risk, also it brings the potential for greater rewards as well. The problem with Ansoff's matrix is that it just focuses on two quite narrow factors. So the markets that the business is operating in, new or existing, and the products that it's looking to grow into. And there's a huge range of other things that should be taken into account in strategic decision making. So for example, the strengths and weaknesses of the business. If you've got an instantly recognizable brand all over the world, it might actually make a strategy of diversification, for example, less risky. And also need to consider the external environment which the business is operating in as well. So we said that market penetration is a relatively low risk strategy, but if you know for a fact that the market that you're operating in is declining quite quickly, then a move towards new markets or different products might actually be lower risk than just staying in the same market doing what you're doing.